Good morning, everyone, and welcome to this Kepler Trust Intelligence conference webcast. We will shortly be hearing from Duncan MacPherson and Lorcain, Egan, the managers of Starwood European Real Estate Finance, or SWEF. SWEF offers a higher yield than the equity property trust average from a significant discount of around 13%. While the equity property trusts have had to almost universally make significant dividend cuts during the pandemic, thanks to reduced rental income, SWEF's payout has remained relatively stable, aided by its loans sitting higher up the capital structure. I will go through, again, forgive me if you've all heard this before, but we have around 30 minutes for the presentation, 15 minutes available for questions. Please ask questions using the Q&A function, which you should be able to see, I think, at the bottom or the right of your screen. And I'll put your questions to the managers at the end of the session. We'll do our best to get to all the questions. I do apologise in advance if we can't, but we will share the questions with the manager following the presentation. So with that, I will hand over to Duncan.
Thank you, Tom. Good morning and welcome everyone to the short presentation on Starwood European Real Estate Finance. As you'll notice, the name's a bit of a mouthful, so we'll refer to the company more compactly as SEREF during the presentation. For those of you who haven't met me before, my name's Duncan MacPherson, and I head the Capital Markets Group for Starwood Capital for Europe. As Tom mentioned, presenting with me on the call today is Lorcain Egan. Lorcain is the head of lending for Europe for Starwood and is responsible for all of our debt origination and debt asset management, which covers both SEREF and also its sister company, Starwood Property Trust. Over the next 30 minutes, myself and Lorcain will introduce you to SEREF, and we'll cover this in three main topics today. First, we'll go through SEREF's key features. Then we'll discuss the resilient portfolio performance that's happened through the COVID pandemic period. And we'll conclude on our outlook for new investment opportunities. We've been an early mover in this area, but the non-bank real estate lending space is growing, and there's a lot more to do over the coming years. As Tom said, once we finish the main presentation, we'd be very pleased to take the questions from the audience. But first, on with the presentation. Let's start with a high-level view of the main features of SEREF. SEREF is the largest of the public market real estate debt investors, with over 420 million of NAV. The company's investment objective is to deliver a predictable dividend stream to investors. And we do this through investing in real estate loans with reliable income streams in UK and in Europe. At 5.5 per share, we offer a significant premium to other forms of income, and with a stable NAV. Investments are delivered through our dedicated European lending platform, which benefits from being part of industry leader Starwood Capital Group, which has over $70 billion of assets under management, predominantly in the real estate space. SEREF was launched in 2012, and so now has an 8-year track record of investing 1.3 billion in loans and fully invested portfolio today. That portfolio is diversified across geographies, asset types, and loan types. And with a 61.8 average LTV, the portfolio benefits from significant downside protection through both the equity cushion and the portfolio diversification. The company works with low leverage. Company level debt is restricted by policy to 30% of NAV and was 5% at the year end. Now moving on to some of the key numbers. I'm going to pick out some of the key facts off this page and explain them. Most of the numbers presented are from the 31st of December when we last reported, and some exceptions here in relation to the share price, which was prepared off the share price on Tuesday 2 weeks ago when the presentation materials were prepared. At that time, the share price was 92 pence, and adjusting the NAV for the shares going ex-dividend NAV was 1 or 2.6. As Tom mentioned in the introduction, that means we're trading at a double-digit discount to NAV. At this pricing, and taking into account our dividend policy target of 5.5 pence, you can earn a 6% running yield and still have also the capital growth potential to NAV. We think the 5.5% dividend is great income if the shares were trading at NAV, and we do not think that a discount is warranted. Global credit peers now trade near or above book value, and our sister company in the US is a good example of this, trading above book value, and often owning many of the same loans that are included in this portfolio. The other key numbers on the page highlight the diversity of the investment portfolio, with 18 investments in total and a total commitment of £490 million. Lastly, on this slide, to just reiterate the large equity cushion providing downside protection for this lending strategy, with our average 61.8% loan to value. I'm now going to run through the why, the what, and the how of what we're doing. So a refresher on the opportunity. There's a long-term macro trend at work in real estate finance, which we've seen play out in the US historically, but is in the earlier stages in Europe. Post-global financial crisis and onwards, banks have been and will continue to reduce their exposure to capital-intensive asset financing. We have been and we expect to continue to be able to capitalize on this long-term growth opportunity for non-bank lenders. Through our approach, we're delivering strong risk-adjusted returns by having a flexible investment mandate. With a 5.5% dividend target, we give a core plus equity level return through investing in credit, which is offering the significant downside protection. Loans are more defensive than equity investments generally, and a diversified portfolio further reduces the volatility of outcomes. Of course, all investing, including lending, has risk. Loans are secured by real property, but typically are non-recourse to the ultimate owners. Loan performance does rely on the ability of the underlying real estate to pay interest and loan principal repayment. This is why we perform detailed underwriting on all of our investments. Now running through a little bit of what these loans look like. They're typically either mortgage secured senior loans or mezzanine loans secured by all types of real estate. We've invested in office, retail, industrial, hospitality, student accommodation, hospitals, senior living, and residential. Investments are across the major markets of Europe, but our historical focus has been in UK, Ireland, and Spain. Under the investment policy, we can have LTVs between 60 and 80%, but our current average LTV is at the low end of that range. No loan can be greater than 20% of the overall portfolio by policy, and currently our largest commitments are just over 10%. The next part is how do we do this? We've laid out three key parts to that process here. Access to this product has significant barriers to entry, which is one of the reasons why there are so few options available in public markets for this strategy. Our market-leading platform is key to the success of the strategy. We were a first mover in this long-term trend in non-bank lending in the real estate space. Having been a leader in the trend in the US, Starwood has also been ahead of the pack investing in credit in Europe over the last 10 years. This gives us a critical mass, both in terms of the team and the capital. In addition to SERF capital, we have in total £3.2 billion of AUM in debt in Europe when combined with other Starwood vehicles. We underwrite the strategy with the benefit of an owner's perspective. What does that mean? We have an internal resources, knowledge, and expertise in real estate that other banks and most competitors do not have. Starwood's 29 years of experience and 4,100 person organization gives us benefits that help us both in terms of sourcing and underwriting the assets that we lend against. It also helps us talk the same language as our borrowers, helping us to understand their needs and build trust. Flexibility has been key as well. Some funds can only invest in mezzanine, or only in development, or only in the UK, or some other characteristic which is very narrow. By being able to move around sectors and geography throughout the cycle, it enables us to select the best opportunities at any given point in time in the whole European market. I'll give you an example with geography as a simple example. One of our first loans in 2013 was to a light industrial player, and we did our first loan with them in the Netherlands. Since then, we've done further business in 8 different countries, including one of the loans we did last year in the UK and Germany last year. So as I mentioned earlier, the key here is getting access to a hard-to-access market, and the products delivered by Starwood being an industry leader. I'm going to quickly guide you through some slides that tell you a bit more about Starwood. Firstly, a snapshot of Starwood as a firm. We're in our 30th year, and we've invested in all real estate asset classes. Currently have $70 billion of assets under management across equity and debt, and the vast majority is in real estate. A quarter of these assets are in the debt space. Some of our credentials are presented on the page, including our experience of investing. Over the past 29 years, the firm's funds have been the owners of numerous investments, including over 230,000 residential units, 310,000 hotel rooms, 87 million square feet of office, and numerous other investments across various asset classes, including industrial, retail, data center, healthcare, and many others. On the debt side, Starwood has made over $70 billion of loan investments over its life. Slide 8 is awards. Our achievements have been acknowledged by top awards. In Europe specifically, we've been awarded Regional and Sectorial Firms of the Year, Nordic Firm of the Year, German Firm of the Year, Global Hotel Investor Award, and so on. All these awards are important, but the most relevant one here is the one on the left, which is Starwood's European debt business was voted by our peers as European High Yield Lender of the Year by Real Estate Capital, the most prestigious award in the space. Slide 9 outlines another debt-specific advantage that SERF has in its partnership with sister company Starwood Property Trust. Starwood Property Trust is New York Stock Exchange listed and has a market capitalization of over $6 billion. In partnership, it gives us the opportunity to invest in larger deals that otherwise would be too large for SERF on its own. We have the benefits of mutual cross-pollination of ideas, sourcing and underwriting standards. This has been an important contribution to SERF. Almost half our loans were co-invested with SPT, and this has helped facilitate SERF's growth. Moving on to the local team, I've introduced myself and Lorcain previously. We've also included our Head of Debt Asset Management, Irene Ryan, and our CFO, Sarah Broughton, on this page. Each of us has a different background, but all of us have a long history of working in real estate, in banking, accountancy firms, and at Starwood. We've been working together for 8 years as a group now, and between us, we've transacted in 20 different countries across every real estate asset class, with extensive experience in all aspects from origination through to workout. I'd like to highlight in particular Irene's team of 3 for debt asset management. This is an often overlooked part of other credit businesses, which we put a very high value on. This area is critical to managing credit, and her team's active engagement with our borrowers helps us identify issues and resolutions before they become problems, and to secure better outcomes for us as lenders through the deep knowledge of our investments and early actions. And we'll discuss that a little bit more in the portfolio update. I'm now going to give an overview of the investment process. For those outside the industry, it may be surprising the barriers to entry and the timeframes involved in investing. Large commercial real estate loans are highly bespoke, and typically start to finish processes take around 3 months. The key stages are shown on the slide. Starting with origination, through our dedicated debt team and sourcing through other areas in the firm, we see a very large number of potential opportunities. These are filtered down very rapidly to the most appropriate based on risk and return and probability of success. While our market presence also brings inquiries from diverse sources, most of our deals are with people the firm already knows well, either as an existing borrower or a specifically targeted new borrower. Once we've selected a target deal and successfully agreed terms with a borrower, detailed underwriting involves a deep dive into the key aspects of the proposed investment, focusing on sponsorship, the specific real estate, the macro and micro of that real estate, the particular business plan, and ESG impact. In the underwriting phase, we leverage our existing institutional knowledge, and then we dig deeper into every aspect of the deal, including obtaining third-party diligence reports. For transaction management, we face almost all of our borrowers directly rather than buying paper from banks. And this allows us to access to underwrite the business plans better and the property better, and to negotiate bespoke structures that suit us. In addition to the deal team and our internal legal team of 4 people in Europe, we use a small bench of top-tier external counsel to assist us in negotiation and execution of loan documentation. Next, investment committee comprises 7 of Starwood's most senior professionals, including myself and Lorcain, and 5 other of the most senior executives within Starwood. IC is briefed frequently on key aspects of potential investments throughout the process, but there's also a final formal committee where investment opportunities are presented and scrutinized in detail. Again, back to asset management, this is a full life cycle activity We track loan performance, key performance indicators, borrower objectives. We believe our team is best in class here. Our borrowers benefit from a well-staffed and responsive approach, and we benefit from much better insights into loan performance than other lenders. I'm now going to pass on to Lorcain to cover the next slides on the opportunity set.
Thank you very much, Duncan, and it's great to speak with you all today. Post-global financial crisis, Starwood identified an emerging market for commercial real estate finance. Our thesis at the time was that we would witness a secular trend reducing traditional bank dominance of the real estate finance universe. SERF was established to target this new addressable market in Europe, focusing on loans which have strong equity cushions, regular and predictable cash flow returns through interest payments, and best-in-class structured finance implementation of loan documents. Since 2013, Starwood's European lending business has grown at a 22.5% compound annual growth rate. Our business has a strong competitive advantage. We have scale through our platform, hands-on real estate experience, and our management team has proprietary relationships with the best quality real estate investors in the industry. These top-tier investors, which you can see outlined on page 14, are the majority of our borrower cohort. We target loans secured by high-quality real estate in liquid markets. Our loans are typically short to medium term, ranging on average from 3 to 5 years, and they benefit from robust structures, encapsulating early warning triggers and financial covenants.
Here we illustrate the relative return for the SERF strategy versus other forms of credit. The blue bars are SERF's returns, showing whole loans on the left blue bar, mezz loans in the middle, and the right-hand bar is the portfolio blend. Having a look at the comparisons we've put on the slide, starting from left, we've put government bonds and high-grade investment-grade bonds here. And you can see the issue is that we've moved from a low yield to a no yield environment for these forms of credit. In the middle, we've shown two leverage finance metrics for higher risk in credit. The European crossover credit, which is the 40 most liquid low investment grade and high non-investment grade names, is generating less than 40% of our blended portfolio return. And the US high yield index, which is junk bonds, is less than 60% of our portfolio return. We view this income premium over these forms of credit for asset-backed real estate loans as highly attractive. The next slide here, we're illustrating the spread of our return over risk-free rates. The blue line at the top is SERF's dividend yield. The black line at the bottom is the 5-year sterling swap rate. And the red is the spread between the two. Since over the last few years, and particularly since the onset of the pandemic, risk-free rates have collapsed. We've also lowered our dividend. We've lowered it from where the dotted line is to where the red cross is. But the key thing to take away from this slide is that the risk premium over the swap rate has been maintained, and we expect to be able to do this on an ongoing basis. The last slide here is comparing dividends for income for people who are interested in this, which we think is a particularly interesting topic at ISA-time. Here we're looking at the FTSE All-Share dividend yield against SERF's dividend yield. Again, the difference between the blue line and the blue cross at the right-hand side is the pro forma for our 5.5 pence dividend yield target. At that level, we have a 310 basis points premium over the FTSE All-Share dividend yield. That compares to 150 basis points during 2019. The conclusion of these three slides is that SERF's providing a rare opportunity for income in a very low yield world. I'll now pass back to Lorcain for slide 20.
SERF has undertaken £1.3 billion of lending since inception in 51 different loans. We have so far witnessed 2 cycles of loan investments and repayments through the business with £871 million of loan repayments and no impairments incurred to date. This demonstrates the value of our origination and risk management model. Since inception, the company has paid £155 million of dividends to its investors.
This slide, we show how SERF has steadily grown over the past 8 years. We've successfully invested repayments on our investments and grown at a prudent rate. We've done this while managing risk. As you can see from the trend in the average LTV, which is the grey line at the top of the chart, it's been very steady in the mid-60s and is currently lower than its average. The opportunity to grow further is available for this vehicle, and Lorcain will discuss this later in the presentation. I'm now going to pass over back to Lorcain to run through a portfolio update.
Thank you, Duncan. We have curated the loan book very carefully, and over time we have maintained a steady last pound LTV in the low to mid-60s, as we saw in the previous graph. Today, the loan book has 18 loans totaling £490 million of commitments, with an average first LTV attachment point of 18.2% and a last LTV detachment point of 61.8% LTV. Our loan book is very well diversified by asset class and jurisdiction. 62% of our loan book is in whole loans. This is substantially higher than we initially envisaged when the company was established. We've been very focused on our core jurisdictions of the UK, Ireland, and Spain. Almost 80% of our loan book is secured by investment loans. Whilst we have a broad mandate that enables us to select the best available risk-adjusted returns on offer across the European lending market, our thesis has held steady over time, and we have focused our origination efforts on our core markets. As of today, the UK, Ireland, and Spain represent 91.9% of the company's total loan exposure. With our average LTV across the portfolio at 61.8%, we have significant equity subordination across our loan portfolio at 38.2%. This provides significant downside protection if there are valuation declines at an asset level. Combined with this modest LTV, our weighted average interest cover ratio is 2.2 times. This is one of the key reasons why all of our borrowers have paid their interest in full and on time throughout 2020. When we established the company, we wanted to create a business that could withstand shocks in the system and be resilient in tougher economic environments. That is what we have witnessed in the overall performance of the portfolio. Almost 50% of the portfolio has required no modification during 2020. We've collected all our interest and amortization payments. In the tougher sectors, our loans remain well capitalized over the medium term and have no liquidity issues forecasted. Our construction and refurbishment risk has reduced by 28% since mid-2020, and all remaining construction assets are capitalized through to their projected practical completion and beyond. 45.5% of our loan portfolio is secured by real estate in the office, residential, and industrial sectors. These sectors have performed exceptionally well in our portfolio. Rent collections have been strong, residential sales have continued at a robust pace, and sales of assets are happening regularly at or above our underwritten valuation levels. Our thesis remains as strong as it has ever been. Q1 will likely be Starwood's biggest quarter of loan origination in Europe. These loans have solid risk foundations and generate attractive risk-adjusted returns. We remain at the early stage of non-bank penetration of the real estate lending markets in Europe. We expect to continue to see record levels of pipeline deals across our core markets. We are witnessing a secular trend which is firmly in play, coupled with a cyclical tailwind that we are seeing at the moment. Since 2013, our business in European lending has grown at 22.5% CAGR. Based on origination levels and pipeline opportunities, we expect this to be maintainable over the medium to long term. Our balance sheet is strong and our foundations are solid, enabling us to take advantage of the next wave of originations.
Thank you, Lorcain. There are some more slides in the deck, which we'll leave you to read later, but we're going to leave that there in terms of of what we run through today. You'll find some case studies and some more details of the team later on in the presentation. But in conclusion, we hope you found the presentation was helpful. And just to summarize, the strategy allows you access through a best-in-class manager to a growing industry. We have a resilient loan portfolio and a long track record. A highly attractive income yield, even if the shares were trading at NAV. And at the moment, there's an opportunity to benefit from a discount, which seems out of line with peers and that we aim to narrow. The last comment I'll make before we hand it over to questions is that we have also put our money where our mouth is. Both Lorcain and myself have bought shares in the middle of last year and again in February this year. Thanks for your attention this morning. I hope you found the presentation useful. I'll now pass back to Tom to present the questions.
Thanks, Duncan, and thanks to both for the presentation. We've had a few questions coming in, but please do keep your questions coming. Hopefully we'll have time to get through them all. There's been a question around the dividend. So since launch, the dividend has been cut twice. What confidence can we have in the stability of the dividend going forward? And perhaps you could explain, what drives the dividend and the income that you're able to earn.
Sure, that's a good question. And I'm going to refer to one of the slides in the presentation, which I think is useful to sort of demonstrate the point here. So the strategy is one where we earn returns from basically three components. We earn returns from fees that we charge borrowers, upfront fees, exit fees, and sometimes prepayment fees if people repay us early. We earn interest, which is made up of a LIBOR component at the moment that will move to SONIA, typically for pounds over the next few months, plus a margin over the top of the interest rate, the base rate interest rate. So what we've seen is that the base rate interest rate component has fallen during our life since 2012. And so the adjustment that we've made to our dividend really kind of reflects the adjustment that there has been in underlying base rates. And we use the 5-year swap as our benchmark there, as most of our loans are based off 3 to 5 year tenors. So, what I'm trying to, I guess, probably draw attention to is just looking at that little red cross at the right-hand side of this slide 17 and how it compares with that historical premium over the 5-year swap rate. And I think when we put it in that context, the credit aspect that we've been earning on has been pretty steady over this time. And we also expect that to continue to be the case as we move forward. I think one particular thing of interest and note is, in kind of more liquid forms of credit, perhaps if you look at, for example, the crossover as an index, you'll see a lot more volatility in terms of how, the high yield world prices, how leveraged finance world prices. Whereas I would say that the way that capital kind of gets formed in the real estate lending space means that there's a steadier approach to what required returns are over the cycle. It tends to mean that you don't have these big fluctuations in terms of rates either going up, but also of going down either. So it's much more steady as you go environment due to the high barriers to entry.
Thanks, Duncan. And then we've had a question around the geographical focus of the portfolio. So maybe Spain and Ireland aren't necessarily the strongest countries in Europe. Could you explain why these are interesting areas for you, why you tend to focus on those two countries in the UK?
Lorcain, do you want to take that one?
Yeah, thank you very much, Duncan. It's a very good question. When we established the vehicle, our primary focus really was looking on a dislocated banking market and where we could find the best risk-adjusted returns. I think what we've seen in the three core jurisdictions that we focus on, UK, Ireland, and Spain, is the most obvious retrenchment of the pillar banks. The four pillar banks in the UK. Ireland, with the NAMA process, saw a big retrenchment in the banking system and real estate finance. And as of last week, Ulster Bank announced they would be winding up their business. And in Spain, we saw a big retrenchment on the banking side. So that provides us with a very clear, open, addressable market. On top of this, we've actually seen very strong fundamentals on the real estate side. So these sectors, these jurisdictions have all performed very well over the last 5 or 6 years. Growth in underlying real estate values, stability of income. And if we look at our rent collections on our Dublin portfolio, for example, they've stayed in the high 90s and the whole way through the COVID pandemic, arguably one of the highest performers across the European market. So there's a couple of things happening here. First of all, it's a very big addressable market for us. We think there's a big gap for non-bank lending, and the underlying real estate fundamentals have been robust during the period of our investment.
And maybe just to add, Tom, the other thing that's we benefit from here is that because these sort of fundamentals are this way around, it also means that our equity business is investing in these markets as well. So when it comes to the point I mentioned before about shared knowledge and resources and expertise, there'll be times when we're benefiting from portfolio data that we're hearing from our equity investments, or anecdotes we're hearing from our originators on the ground in these various markets, which is, I guess, kind of proprietary, gives us proprietary benefits in terms of understanding the markets that we are in. And likewise, if Lorcain's talking to a broker and getting an update on the market in Madrid, he'll be passing on that intelligence if it's appropriate to his equity colleagues as well. So this is another example where actually the footprint of what we're doing in terms of asset classes and geographies is often mirroring what's happening in the larger investment sphere of Starwood.
There's a question here about the possibility of capital values being hit. So the questioner has seen in the latest report there's 30% of the portfolio is at stage 2 risk. Could you give us some comment on why this won't deteriorate, leading to defaults, and perhaps that explains sort of the security of your investments?
So the assets which are in the stage 2 basket are in areas which have been operationally affected by the pandemic. So for us, that means hospitality and retail. And obviously with state mandated lockdowns, these are asset classes which were not able to operate during the pandemic. So with income at risk, this was the reason why these areas were put into stage 2. In terms of what happened is that actually within the discussions we've had with borrowers, we have reserves in place in many of the loans already, but also with income being disrupted, there's covenants that get tripped in terms of measurement of income related financial covenants. And as we've discussed with borrowers how they're going to deal with the disruption, we've managed to negotiate in further reserves, which have meant, as Lorcain said, that not only has every interest and amortization payment been met, but also we can see reserves in place to meet liquidity needs in the short term. So, very much at the beginning of the pandemic, we put all resources into updating our scrutiny of the portfolio, which, as I kind of mentioned earlier, with Irene's team is already a very strong function within the organization. We made sure we put loans that needed amendments on strong footings with the negotiations with the borrowers. And the first part of that is in relation to immediate income disruption. And then I think the sort of lead-on question from that is then also, well, what happens in the fullness of time? How are valuations likely to be impacted, and the ability of the loans to be repaid based on a refinancing or a sale of the assets? And I think, you know, when we look at the sectors again, where valuations are likely to be impacted, again, it's in the hospitality and the retail space. If we look at all the other sectors, actually, there probably has been an improvement in valuation and certainly in risk on every loan of ours outside of the hospitality and retail sector, as low interest rates have basically put even further pressure on real estate yields in the markets we're in. For the hospitality side of things, I think we're actually coming out at this stage the other side of some of the uncertainties that we were experiencing at a peak, perhaps during the last half of last year. So when we look at where our large exposures are on the hospitality side, a large proportion of it is in domestic or short haul tourism related assets. And as we look at what the leading indicators are, it appears that these are the areas that are going to recover first in terms of income, but also in terms of the data around how the transaction market's performing as well. We're beginning to see increasing numbers of single asset transactions occurring within the market. We're not quite at the level where we're seeing a lot of portfolio activity, but certainly for single asset transactions. So we're seeing a recovery in the capital markets and in the financing markets for the hospitality side. We're still wary on the retail side, and we did refer in our fact sheet to having a revaluation being done on the retail assets at the moment. What we'd expect is that LTVs will go up on the retail assets that we revalue, but we don't think it would be demonstrative of the portfolio as a whole. And we also don't expect the increase in LTV to put NAV at risk. So we don't expect to have a write down on NAV as a result of these updated valuations, which will be coming through over the next few weeks. I don't know, Lorcain, if you want to add anything on this side.
I think that's very clear. I think the only thing I would just clarify is that when Duncan references reserves, that is cash reserves within each of the loans to pay the necessary interest and amortization payments. That's all I would say.
So I think you've partly answered some of this question when discussing the reserves, but can you talk through any other features that the loans have which have helped protect investors during the COVID crisis, and specifically regarding the Irish hospitality exposure? Can you talk about how the value of that loan has been protected through the various initiatives that have been undertaken there?
Of course, yeah. I think the first thing to mention is that from an origination perspective, we're very focused on the type of risk we put into the business, and we've sort of curated the loan book. And we've done that with the benefit of looking back at data from prior to the global financial crisis. Over 70 billion euros of loans originated prior to the global financial crisis, and we studied where the inflection points were on risk. And so it's not by accident that, you know, our target LTV is in the low 60s, and the target yield on debt that we try to get to, the income in the asset versus the amount of debt, is high single, low double-digit percentages. And that's really where we saw a material change in losses after the global financial crisis. And that's how we've tried to manage our exposure, and that's why I think we've been in a good position of being able to collect all the interest and all the amortization on the portfolio. So it's through past knowledge, experience, and data analytics that we've really created a portfolio which we think will withstand economic impacts. In terms of the Dublin hospitality asset, I think it's a really good example of the proprietary relationships we have, and this sponsor executed a really great asset management initiative, which we've outlined in a number of our fact sheets and supplementary information, which we post on our investor relations page. The sponsor executed a license agreement with the HSE, which is Ireland's equivalent of the NHS, and essentially licensed the hotel for use by the health service executive during the COVID pandemic for a number of different uses, for overflow from hospitals through to quarantining for people who needed to quarantine, through to other services which were required during the COVID pandemic. And this resulted in the hotel being able to generate a decent amount of net operating income during a period when most other hotels across Europe were closed. And it results in the hotel benefiting from having positive cash flow during what is been a tumultuous period. So I think that's a really good example of a top-tier asset manager moving fast, reacting to what's going on around them, and protecting their asset.
And Tom, I think there was an element to the question about, what are so in terms of structures, how do you kind of gain protections? And I think that's something that we pride ourselves in terms of the way we go about putting together our deals. If fundamentally the way these deals are structured is in a structured finance way, and what that means is that they're quite restrictive loans in terms of the flexibilities that a borrower has to do things that weren't incorporated into the original business plan. And if things aren't going right with respect to deadlines for key dates of performance, whether that's implementing capital expenditures that they have undertaken to do, or whether it's meeting a performance test in terms of we mentioned earlier, income-based tests, and how the hospitality and retail loans were disrupted through having to have the shutdown during COVID, and also typically with LTV covenants as well. And so what these constraints within the loan agreements allow for is to have a very regular dialogue when things aren't quite going right, and an early dialogue when things aren't quite going right with the borrower, to be able to address why that's not working out, and also how to go about resolving it before things have really gotten too bad. And I think that's perhaps a big difference between how you kind of leverage finance works and kind of structured finance works. Usually in the leverage finance world, there's a lot of flexibility about how people can run and grow businesses. But in the real estate lending world, it's very tightly defined what you can do and what you can't do in terms of the documentation and the constraints within it. So one of the things that's important is to get that right, because you need to facilitate your borrower's business plan. And a good example of that was whenever we had the call from our borrower in Ireland about implementing something that was of value to both the HSE, to our borrower, and to us. We were able to react very quickly to that, and to allow for him to implement that contract, which was something that you wouldn't normally be able to do under the documentation, and that led to a successful outcome for everyone. But it's a good example. You can't just go about entering into a major contract, a structured finance deal. You need permission from the lender. It's another, I guess, example.
In the interest of time, I might parcel these two questions together, but there's one about, given the structure of the portfolio, is the potential for NAV and share price growth as well as income, and then secondly, looking at the market at the moment, what is the current sort of opportunity set for you? Are there lots of potential deals out there? Is it an attractive moment to be investing in this market?
So I'll take the first part, and then I'll pass to Lorcain for the second part. But in terms of the strategy, this is very much a stable NAV strategy. We're trying to make consistent, steady returns, and we're not looking to take partial equity risk or performance in the underlying deals we're lending against. We're trying to strike the risk point at a level where we earn a credit return and we don't have to participate in the equity. So you should expect a very steady NAV. In terms of the share price, we think the discount to NAV is unjustified, and we do anticipate that that will normalize over time as markets, continue to recover from the pandemic shock, and as we continue to get the message out about the resilience of the portfolio's performance. So unfortunately, no big NAV accretion opportunity, but from the perspective of an investor today, double-digit reversion to NAV from the share price today, on top of a very attractive income yield, I think is an exciting proposition in a world where there's practically no yield. And then, as to the future, I'll pass over to Lorcain on this, and he'll give you some of the highlights.
Thank you, Duncan. I think we mentioned earlier in the presentation, and just to elaborate on what we said, we think it's a very exciting period for non-bank lenders in the real estate universe going forward. At present, my team is assessing 23 loans totaling £1.7 billion of potential value, and all of those loans display very strong risk-adjusted returns. We're in a secular trend here, which is started post-global financial crisis and is continuing with pace. At the moment, non-bank lenders in the United Kingdom, which is a really good example for broader Europe, and pretty much similar to the statistics for Europe, but non-bank lenders represent about 12% of commercial real estate lending in the United Kingdom. Prior to the global financial crisis, this was in the very low single digits. At 12%, it's much lower than the United States, which is a mature market, and the non-bank lender market sort of kicked off and began in the late 1950s there. So it will take time to mature, but there's a lot of potential growth, and we think that this secular trend will continue for the foreseeable future, and it's been compounded by COVID and a further retrenchment from the pillar banks.
I'm just going to sneakily squeeze in one last question, but if you could answer briefly, please. So you showed the yield of the loan portfolio over LIBOR. Could you give us an idea of what sort of premium loans are currently being originated at? So not so historically, but at the moment.
I mean, Lorca, maybe you want to comment. I suppose there's a variety of different rates we have on our loans. Some are lower, some are higher, depending on the exact credit we're putting on. But we're building up a portfolio return that we think we can consistently deliver to this type of premium. I don't know, do you want to comment further, maybe Lorca, about maybe some of the higher and lower ends?
Yeah, look, I think, the way we've always thought about our origination is from a risk-adjusted return perspective, not just an absolute return perspective. And I think particularly coming out of a pandemic, we're going to be very focused on that risk element. I think over time, we've been very disciplined and focused from a risk management perspective on originating good loans. So we're not necessarily just focused on absolute return profile. And so for us, it's really thinking about that subjective measure of risk-adjusted returns. We would say that we can originate better risk loans with the same or slightly better return profile versus where we were in a pre-pandemic environment. And hopefully in the next couple of quarters, we'll be able to provide some more examples of that.
Yeah, I think just maybe to wrap up on this question a bit further, when we moved out of the post-GFC environment and the alternate lenders came to Europe, there was I guess a question mark about whether the opportunity set would persist, or whether banks would move back into the space that they were had vacated. But what we're seeing, as Lorcain's described earlier in the presentation, is this is a long-term trend away from capital-intensive lending by banks. They've really struggled with net interest margins in a declining interest rate environment. They really have a higher focus on use of capital, with higher amounts of capital required to be held against loans. And they're much more keen to find sectors where there's more fee-paying business rather than capital-intensive lending business. So this retreat from real estate has been going on for 10 years now, and we expect it to continue to become the bank share to be a lower proportion again and again over time. And by that's very nature, that's likely to mean that returns for alternate investors are likely to be relatively stable because the universe of competitors from the bank market is continuing to decline. So we see a good outlook over the long term for this strategy.
Very well. Thanks very much, Duncan and Lorcain, for your presentation, taking your questions. And I apologise if we didn't get to one or two questions at the end there, but we'll pass those on to the manager. I would also highlight that we recently published a note on the trust, which should cover a lot of these issues. If you would like to stay on the line, please do. We've got a presentation from BB Healthcare up next. But apart from that, just like to say thank you to the presenters again for taking the time, and thank you to all for listening, and speak to you soon.
Thank you, everyone.
Thank you. Have a good day.
Bye.